Welcome back, everyone. In today's video, we're going to continue talking about trading options, and in the event you haven't seen my previous videos about trading options, I will include the playlist down below so you can watch them in order. But in my prior two videos, I talked about buying calls and buying puts. And in this video, I just want to emphasize, I want to dedicate to should you be buying calls, should you be buying puts. Now, yes, there's a lot of money to be made in buying call options and buying put options. The upside potential is technically unlimited. However, the vast majority of option contracts expire worthless out of the money. And in my opinion, the deck really is stacked towards the sellers. In future videos, we're going to talk about selling call contracts and selling put contracts. But in this video, let's break down the math of exactly why it's just not, in my opinion, it's not a good idea to be buying call and put contracts. So let's do Starbucks as an example. Their share price is currently 104.46. And let's just say that you think Starbucks share price is going up. It's going to go up to 110 in the next 2 months. So you're looking at 70-day call option contracts. Here is an option chain on Charles Schwab. The expiration date is March 19th. We're going to look at the closest out-of-the-money option. So a strike price of 105, this will expire in 70 days. And for the strike price of 105, the buyers are bidding 440, the sellers are asking 455. Let's go ahead and take the mid price, the last agreed upon price of 445 as our example. Now, if you bought this contract, you can't exercise it. It wouldn't make sense. But even if we were at the expiration date, it's out of the money. If you're buying 100 shares from somebody, you're not going to do it at the strike price of 105 when you can get it for cheaper on the New York Stock Exchange. So the contract is out of the money. And for out-of-the-money contracts, once again, there is no intrinsic value. The intrinsic value is $0. So what we're looking at, what these prices are telling us, it's 100% extrinsic value. This 445 that we're paying for this contract out of the money is 100% extrinsic value. So now if the strike price of the contract is 105 and we paid $4.45 a share, or $445 because you got to multiply it by 100, our break-even price is 109.45. You got to add the call contract premium to the strike price, and Starbucks needs to get over 109.45 before we start making any profit on this contract. Now that's only a 4.78% increase, so it does look appealing. You know, Starbucks only has to go up 4.78% in the next 2 months, and I'm guaranteed making money. How great is that? Well, let's break down all of the possible scenarios of what can happen when you buy a call contract. So let's compare these scenarios with buying 100 shares of the stock today, just own it, versus buying the call contract, which will eventually cause you to buy 100 shares of the stock. If the stock goes down and you own the shares, then your losses are technically, if the stock price went to zero, it'd be 100%. But we're just going to say X dollars. Now, with a call contract, your losses are limited. This is one of the upsides of buying contracts. The most you can lose is the premium you paid for controlling 100 shares of stock. So the most you can lose is $445. But what if the share price of the stock stayed the same? Over the next 2 months, it finished exactly where it is now. Well, if you just owned 100 shares, then there'd be no dollar change in the value of your stock. However, for the call contract, you lost $445. Now, what if the stock price of Starbucks goes up just a little bit? Let's say $2. Well, this actually does take you above the strike price. And if you owned 100 shares, you'd gain $1 times 100, so $200. Now, what's happening with your premium price is you're starting to earn it a little bit back. It didn't go up yet, $4.45 above the strike price. That's your break-even point. But you earned a little bit, so you only lost $299 on your call contract. Now, what if the stock went up $4.99 a share? This is actually how much the stock needs to move up to get above your strike price of 105 by your premium cost of $4.45 a share. If you owned 100 shares of stock, you would have gained $499. And here it is. You're back to $0. This is the break-even point for your call contract where you don't lose any money. And it's only if the stock price goes up more than $4.99 do you start gaining that theoretical unlimited amount for a call contract. Now, if you just bought the 100 shares and owned it, whatever it goes up by, that's the profit you make. And for the call contract, you earn that same amount, X, minus what you paid for the contract, which is the premium of $445. So just visualize all the possible scenarios. Now, I realize that these scenarios are not equally possible. They have different probabilities. But if you just buy the stock and the stock goes down, that's the only time you lose money. However, with a call contract, you lose if the stock goes down, you lose if the stock stays the same, you lose if the stock only goes up by a little bit. And it's only making you money when the stock goes up huge. Let's go ahead and think about a put contract now. It's going to be similar, so we're going to go through this a little bit faster. And let's say, once again, for Starbucks, you're going to choose the March 19th expiration day in 70 days. And this time for a put contract, the strike price is below the current share price. So we'll select 100 as the strike price. Once again, all of these dollar amounts that you're paying is entirely extrinsic value. Right now, this contract is not worth anything if you exercised it, so there is no intrinsic value. So we'll go ahead and use the $319 price for the premium for the last agreed upon price. And once again, you can't exercise this contract. It doesn't have any intrinsic value. With a put contract, you're forcing somebody else to buy 100 shares of stock from you. So would you make somebody buy 100 shares from you for 100 when you can get 104 on the New York Stock Exchange? You can't do this. You need Starbucks price to drop before this contract has any intrinsic value. So the recap is strike price of 100. The put contract is $319. So you need, for your break-even point, for the stock price of Starbucks to go $3.19 below your strike price. So the break-even point for you for Starbucks stock on this put contract is the share price has to go down to $96.81, or the stock must drop 7.3%. And here are all the possible scenarios with the put contract. If the stock price goes up and you short sold, now it's not you own 100 shares, you short sold 100 shares. Technically, your losses are unlimited. With the call contract, the most you can lose is the premium of $319. If the stock trades sideways, if you short sold, you wouldn't lose anything. But for the call contract, once again, you lost everything $319. If the stock price goes down $5, then if you short sold it, you would have made $500. You're now starting to earn back your premium cost. So you didn't hit your break-even dollar amount yet, so you would lose $265 on the call contract if it expired and the stock price only went down $5. Your break-even dollar amount that the stock price has to fall is $7.65. If you had short sold it, you would have made $765. For the call contract, you made nothing. You reached your break-even. And it's only if the stock goes down huge by X dollars, then for the call contract, you'd make X dollars minus what you paid for the premium. Now, for the probability of profit, some brokerage accounts will calculate that for you. However, I would be dubious of that calculation. You can't predict the future, so I don't like looking at those. Charles Schwab does not give you a chance of profitability, but I think Robinhood does. If you want to look at it, it can be useful for you. The point I want to make, though, is that for buying call and put options, these are high risk, high reward, and they are wasting assets. They are becoming less valuable over time. So think about this. For the call contract with Starbucks, strike price 105, you're paying $445 for no intrinsic value. So it is 100% potential over time, or extrinsic value. And extrinsic value is made up of time decay and implied volatility. So how volatile the stock has been recently versus just the time to expiration. And let's talk about theta decay because this is very important to understand. So your brokerage platform should include the Greeks. On Charles Schwab under strategy, you can switch this to say Greeks, and then it'll show you vega, theta, gamma, delta, implied volatility for all the call contracts and then all the put contracts. So let's look at an example here. The expiration date of March 19th, and then you look at the strike price of, let's say, 105. So the theta here is a negative number. Same thing with the put contract. The theta is always a negative number. And it's telling you how much this contract is becoming less valuable every day. Every day it's decreasing by, for example, for the strike price of 105, it's decreasing by 0.033, so 3.3 cents per share per day. Or if you want to multiply that by 100 to think about it, this contract is losing $3.30 worth of value every single day. And that includes Saturdays and Sundays, days the markets are closed. Every day that people are holding this contract, theta decay continues, and you're losing $3.30 a day. And theta decay increases the closer you get to the expiration date. So here is January 15th, which is 5 days from now. Theta decay for these contracts is negative 0.081 or $8.10 a day. Same thing with the theta for the put contracts. They're both negative because the contracts are becoming less valuable for the buyer, meaning the sellers are gaining this much a day. So theta increases the closer you get to the expiration date as your extrinsic value evaporates. It just bleeds away. You're losing $8.10 a day by holding this call contract. And theta decay in the far future is far less. So when you look at January 21st of next year, so this is 376 days in the future, theta is negative 0.013 or $1.30. So $1.30 is bleeding away from the premium of this contract every day for the next 376 days, and it's going to increase the closer you get to your expiration date. So let's just line them up and think about it for these call contracts, how they're wasting away and losing value. So here's an expiration date in 5 days, in 68 days, in 376 days. So if it's in the far future, you're still losing money every day to theta decay, but it's losing at the lowest rate. In the mid-future, you know, in 3 months, you're losing about $3 a day. And then in the near future, the next week or so, you're basically losing all of that extrinsic value until the contract becomes worthless out of the money. So the two ways that option contracts are stacked against the buyer is theta decay, the fact that the contracts become less valuable over time, plus your break-even point, the premium, the amount you paid for the contract. You have to overcome that in price movements before you ever start earning a profit. So both theta decay and the break-even points are hurting the buyer and helping the sellers of these options. Which transitions us to where I think the real money is being made in trading options, and that is selling contracts, selling calls, and selling puts. My next video, I'm going to talk about the Greeks because I want to explain those all a little bit more in detail. But after that, we're going to talk about selling call options and selling put options because there's a lot of great strategies that, in my opinion, are win-win. And I think, once again, that is where the real money is being made. Okay, guys, if you enjoyed this video, give me a thumbs up so the algorithm knows it's good. In addition, consider subscribing to my channel if you haven't already. Once again, I will include my playlist of all my videos related to trading options down below. And if you guys have any comments or questions, let me know. Until the next video, take care.